We're speaking today on December 6th, Friday. Payrolls numbers came in. Payrolls increased by 227,000 in the U.S., more than expected. The unemployment rate is now at 4.2%. So we'll give an outlook on the economy, which sectors may do well into 2025, and how investors could look into positioning their portfolio. Speaking today with us is Father Emmanuel Lemelson. He is a Greek Orthodox priest. He is the CIO of Lemelson Capital Management. He is the creator of the Father Emmanuel Lemelson podcast. He's also been featured on an HBO Max series called Wall Street. Father Emmanuel, very honored to have you on the show. Thank you for joining us.
David, it's an honor to be with you. I really enjoy your show, and I'm very happy to be with you today.
Thank you. Let's talk about first the unemployment numbers that came in today. 4.2%, edged slightly higher from the previous month's reading. It's been hovering around that range for quite some time now. The Fed is concerned. I've seen reports that the Fed is concerned more about rising unemployment than falling unemployment. And as you know, that in the last press conference, Jerome Powell stated that he continues to monitor the labor market. That is an area of concern or potential concern for him. The unemployment rate, the inflation rate rather, has already been coming down. So they're more focused now on the unemployment. Is that a concern for you?
Well, obviously that's one of their mandates is full employment, and that it's only a small uptick in unemployment. But if you can see these sort of official numbers, which always seem to get revised in retrospect, or you can look at anecdotal evidence just by talking to people on the street. And I think there certainly is an interplay between the sense of scarcity of labor in certain sectors, and we saw in this increase in the labor stats, unsurprising categories, leisure, healthcare, hospitality, and government. So in a sense, whether or not we're really reaching that target 2% that the Fed wants, or whether that becomes self-fulfilling because there's a sense sometimes of scarcity in certain industry sectors, I think we have to really look at that and do our own sort of scuttlebutt, because those numbers get revised often enough and in retrospect.
If we were to just look ahead now, the biggest drivers of monetary policy going into 2025, do you expect inflation to come back? Do you expect job numbers to weaken even further? What's your outlook for the economy?
Really hard to say, because there's so many things going on with Trump's, prospective policies. If there really is action taken on, removing the number of persons in the country who are undocumented, or some people say illegal, that would certainly have an impact on employment, right? And so that would be, I would imagine that would be very inflationary. It would drive prices up even further, and certainly as it relates to labor and labor rates. So I think that it's really difficult to know at this point when we're in this transition period between administrations. But again, there's always this issue of that, the fund had this sort of unprecedented increase in money supply going back 4 years ago. And now the question is, even though the Fed's pulled off that so much, has inflation sort of taken on a life of its own as it becomes sort of self-fulfilling? The idea that people expect because the next guy's going to charge them more, they have to charge more as well. And yes, even if we hit that 2% target, which is very modest inflation, and if we could get interest rates down to, 4.25% or 4.5%, that would be wonderful. Everyone likes lower in interest rates, excuse me. We still have to take a really hard look at what happened in those last 4 years in terms of how much prices have come up, and what's that really doing to the American consumer, because so much of our society is driven by consumption, and it squeezed a very large part of the economy, a very large part of the consumers in this country.
If you were to boil down to one or two major investment themes of 2025 that you would structure your philosophy or your investment management principles around, what would those themes be?
Well, we run a deep value fund, so we're always looking for these sort of price value dislocations. Probably not the most popular approach to capital allocation. And what we've observed is this extraordinary volatility in the markets. I mean, you could find studies looking at volatility 10 years ago or 20 years ago. And when you see certain issues, and not just micro caps or small caps, you see it even in mega caps, where you're seeing these fluctuations of 20 or 25% or even greater. I mean, look at Meta today, for example. It was just a couple of years ago, it had fallen precipitously. I think it fell something like 60 or 70% in its value. Now, obviously, the value of the company did not change that much. Now it's at record highs. It's part of the Magnificent Seven. When you see these huge vacillations in price, these permutations in price, if you're looking for value, if you're looking for a price value dislocation, this is still a bonanza, believe it or not, even though the markets as a whole, the major indexes are hitting new highs. So the investment thesis for us is always the same. It doesn't really change based on what the market is doing, what indexes are doing. We're always looking for those price value dislocations. And whether it's algorithmic trading or if it's just greater participation from retail that's driving these price value dislocations, these huge movements in price, we certainly are always watching for that.
Okay, I'd like to show you my screen here. This is the trailing PE multiple for the S&P 500.
Yeah.
Different metrics have slightly different numbers, but the point
Right.
stands that it's not as high as it was pre 2000 and even the tech bubble of 2000, and then obviously we have the great financial crisis here.
Sure.
Wasn't as high as COVID. Now, how would you evaluate the overall valuations of the S&P overall?
Well, I think
Because
that's
that,
one metric
yeah.
to look at, certainly, David, and it's a good one. But I would rather look at the Russell 5000 over GNP, because the Russell 5000 give you a much broader look at the equity markets and capital markets generally than just the S&P 500, which the components are constantly changing, as you know. And if you look at that over GNP right now, I think through the close of business yesterday, I want to say we hit a new record. It's 2.09. I want to say the previous record was like 2.084. So if you look at that as a sort of broad way of looking at equity valuations versus the economic output of the country, we're really at a record high in terms of valuations. So it should be very scary for anyone. You know the old adage, of course, be fearful when others are greedy and be greedy when others are fearful. It's definitely a very frothy market if you were to look at, again, Russell 5000 over GNP, which I think is a broader way to look at the economic characteristics versus the price of equities.
So what do you do as an investment manager when you approach a frothy market, in your words? Do you stay on the sidelines? Do you short? Do you look for alternatives besides equities? I know you look for deep value, but that's a
Yeah.
very micro approach. But when
Yeah.
when you go into a frothy market, what is your mentality there?
Well, first of all, you don't have to swing at every pitch, so you don't have to do
Mhm.
anything, right? I mean, if money is burning a hole in your pocket, maybe you shouldn't be in capital allocation. But to answer your question, yes, we do short. And
Mhm.
shorting is an absolutely terrible business, and it's getting more and more unpopular. You can see so many prominent short sellers have disappeared because the markets just keep going higher and higher and higher and higher. And the irony of that is that shorting should be a better and better business as that happens. I mean, ultimately, these valuations can't be sustained forever. I mean, nothing goes up in perpetuity. The markets depend on these cycles, these permutations in price. And now it's been a very long stretch, but shorting is certainly something we do. I think right now our book is probably 50% short, which is much more than usual. And looking at the markets as a whole is really it's as old as time, frankly, for the modern American markets, where people sit around a bunch of guys and try to figure out where the markets are going to go. But if you're not buying the markets, if you're not buying an index fund or something, you really shouldn't care too much about the market. What you should really care about is individual securities that you're either going to be buying or selling. So you're buying them on the long side, you're selling them on the short side, and that's where you can still find value, especially if you're open to a broader sector, and unloved issues, unpopular issues. They're not beauty contestants, a lot of what we own, and we believe that there's what we'd call a margin of safety. So if we think that the value is demonstrably higher than the price we're paying, we look at that as a margin of safety. We can still find that from time to time throughout the year, no matter what's going on with the indexes. We're not buying the indexes. So yes, are the indexes getting very, very pricey and dear? Absolutely. But we're not buying those. So it's irrelevant for us. We don't sit around and try to prognosticate about where the quote unquote the market's going to go.
Yeah. Can you give us a few examples of sectors or types of companies that you like a lot right now that have, quote unquote, deep value characteristics and
Sure.
potential?
Yeah. Yeah, I mean, a lot of off-price retail, for example, has really had a rough time. We saw the bankruptcy of Bed Bath and Beyond recently, and we've seen everything from Christmas tree stores to Burlington Coat Factory just get pummeled. Kohl's getting pummeled. It's like almost every day we find a new issue that will issue some earnings report, which is not terrible. I mean, it's a bump in the road, but they're dropping like 25%. Guess is another one that we own. By the way, those previous issues we mentioned, the only one we own is Kohl's. But there's even deeper value that we look at. For example, we own a stake in Big Five, which is a very unpopular sporting goods store. They probably don't have any competitive advantage over an Amazon or a Walmart, but they've been around for a very long time. They fill a niche market. They're trading at a pittance, frankly, a fraction of tangible book value. We don't think they're going anywhere. Some of these off-price retailers are paying huge outsized dividends. Walgreens, another one, just taking a beating. If these companies don't go bankrupt, I don't think they will. Well, Walgreens is a little bit of a special situation, but the others are not going to go bankrupt. They're going to recover. And then you've got these issues where you might have paid, 40, 50 cents on the dollar. Most of them are paying really outsized dividends. And, you're not doing what the rest of, I don't want to say lemmings, because it's not true in every case, but a lot of these big tech names, it's like the lemmings going over the cliff with them. If you look at Tesla, for example. And you just don't have to participate in that because everyone else is. So there's enough value to be found. There are certain industry sectors that are getting pummeled, and if you're patient and you know what you're doing and you're reading their financial statements, you should have a significant margin of safety. I think for a lot of these folks who are really speculators, speculation is really an activity where you're trying to take a little bit of money and turn into a lot. But real investing is taking a lot of money and trying to make sure it doesn't turn into a little bit. And that's what value investing really is, a value approach.
Are you betting on then the return of the consumer to spend a lot more money into the next year?
Well, you should never bet, right? Betting is synonymous with gambling, quite
Mm.
frankly, and betting, speculation, gambling, they're all synonyms, right? And I would say if you were to compare speculation to a coin flip, you're probably doing a disservice to flipping coins. I mean, speculation doesn't end well over time. And whether or not the consumers return big time or don't return big time, I mean, if you're buying tangible assets of a company, like I say, at a fraction of their intrinsic value, you've got enough margin of safety you can afford to be wrong. So do they return really in a big sort of way? Do they not return? I mean, take Big Five, for example. Are people going to have their kids not do school sports next fall because the economy's better? Probably not. I mean, most people would mortgage their house to make sure their kids can pay, soccer or whatever it is. So, there's going to be a certain amount of spending that always takes place. If you got that margin of safety, you should be able to sleep at night that even if you're wrong, you're not going to be wrong in a big way.
How do you feel about the big box stores, the Walmarts of the retail world? How do they compare?
Yeah, they're well run. Best Buy, Walmart, all those stores very, very well run. They are squeezing a lot of the smaller players, but we have seen smaller players succeed in niche markets nonetheless. So it can be done. I mean, Walmart doesn't try to get everybody. They have a model that is, about efficiency, as does Best Buy. So there is room sometimes for the smaller players.
Okay.
I remember another
Turning,
smaller sports
yeah.
store, Hibbett Sports, where it was recently acquired, and that was another stock that just been absolutely beat up, and the returns were completely outsized if you bought it at the right time. And you would look at that and say, "Well, look, there's Foot Locker. They're so much bigger." And actually, Foot Locker is another retailer that's beat up right now. In fact, because of some sense that there's a struggle with one of their major suppliers, Nike. We think Foot Locker will do very well in the long run. Even if Amazon sells shoes all day long with compelling technology, people are going to go into stores and try on shoes, and they're going to see the latest brands in person. So, the big box retailers aren't going to cover every sector, and so there is still room for some diversity amongst the smaller players.
It's important you brought that up. I remember when Amazon first started becoming popular and mainstream, people were talking about the death of box stores. People wouldn't walk into stores anymore. That just hasn't been the case. Do you want
There you
to
go.
maybe offer an explanation as to why consumer patterns haven't changed that much?
Well, that's a great thought. It would have been easy to see where the technology is so, in fact, it's so compelling. You'd be like, well, why would you walk into a store at all? You could just have it delivered. But there is a sense of the enjoyment of going out to shop. There is a problem in retail right now with theft. We're living in an environment where there's unfortunately a sort of disregard for the law. I want to say it's $100 billion problem, and it affects all the retailers from Home Depot to Walmart. And you see a lot of these CVS stores and stuff locking up their merchandise behind glass doors. Let's hope that law enforcement is esteemed a little bit more in our future, because I think people do want to go out and shop. I can't imagine, during the holiday season, everyone's like, hey, let's just go on Amazon to shop. I mean, there's a sense of getting out of the house, seeing the product, especially things that are emotive, like tennis shoes, for example. I mean, that's a huge industry. If people want to see it, they want to try it on. And so I think that is going to survive, David. I'm not convinced, even with the problem we're seeing right now with theft in retail. They'll call it shrinkage, right? That's the technical term in accounting, but it's theft, let's be honest. I think that we'll have better days ahead, and there'll be a resolution to that, and there will still be a strong in-person presence for retail.
All right. Well, turning to the tech sector now, I'd like to read to you this paragraph from Financial Times. This kind of goes back to our conversation earlier about valuations. Wall Street's AI-powered rally risks correction. Vanguard warns investors rushing to AI stocks this year has overplayed the near-term potential of the technology, raising the risks of a correction in the share price. Asset management powerhouse Vanguard has warned from an economic perspective, we're roughly in the year 1992, but from the market valuation perspective, I can make the argument that we're in 1997, he added. What's your reaction to this quote? How do you feel about tech overall?
Yeah, I mean, tech is always a little bit tricky, but technology does add to our lives. I mean, if you can invest in great companies, NVIDIA is one of them. It's had, 26,000% return over a decade, I think. I want to say it's over 33% maybe in the last 5 years. Truly a remarkable company. They have better margins. Usually look at the margins of Meta. Look at Microsoft's margins. They have remarkable margins. They're not dealing with inventory. They're not dealing with the cost of running an operation, which is capital intensive very often. But then you have this sort of orbit of everyone around the AI phenomena. For example, who wants to be caught up in it? Look what happened with Supermicro recently. Their auditor suddenly, resigned and the stock plummeted.
Yeah.
And then everyone else is using AI the same way everyone else was using ESG a few years ago. So you have to really know what you're doing. And the answer is really not to follow price movements right on any given day. The answer for the average investor is to read the financial statements and to become at least a basic securities analyst. Because barring fraud, the income statement, which is a little bit fungible, generally should tell the story of the company, especially if you're looking at 5 or 10 years, 30 years even. Same thing with the balance sheet and the statement of cash flows. And those as you go through that list and you get to the statement of cash flows, again, they're increasingly impossible to alter without committing fraud. So, so long as the company isn't doing something fishy with their accounting, you should be able to see what the economic characteristics of the company are. And a lot of these smaller startups that want to use AI to be caught in that orbit of great companies like NVIDIA, I think you got to be a little bit careful of that.
Actually, could you educate us, Father? What do you look at when you get the three statements? Because most of us watching the show aren't familiar with analyzing financial statements. I'll give you a personal anecdote. So many years ago, when I was still working in the finance industry, I applied to work at a hedge fund. Spoiler alert, I didn't get the job, so I'm doing this now. So now I'm asking questions to fund managers. But anyway, the question asked to me, one of the questions asked me during the interview was, I give you the three statements, financial statements, income statement, cash flow, balance sheet. What are the three metrics or ratios that you look at first? So,
well, most people will start with the income statement because they want to know what the sales are. People think in business, think about sales all the time. And for a lot of business people, certainly CEOs of companies, believe it or not, even CEOs of prominent companies don't know how to read financial statements because they think the language of business is sales. But I'm here to tell you the language of business is not sales. It's actually accounting. In fact, the oldest recorded records that we know about in the world from ancient Mesopotamia are accounting records. So if you're going to run a business and not know how to read your own financial, or if you're going to allocate capital, which is buying a slice of a business, you really shouldn't be doing that unless you can read the financial statement. Now you can learn to read the basics of financial statements in maybe 30 minutes. There's a great book by Murray Buffett on the interpretation of financial statements. It's maybe 70 or 80 pages. You could read it at a night. If you got into it and you really enjoyed it, you could graduate eventually to something like Security Analysis by the great Ben Graham. But you could start with the income statement. I would say look at consistency in the income over the years. And when you see headlines that talk about adjusted earnings, and they even have, adjusted earnings, and it gets into all this, by the time they're done with it, you're like, what does it even represent? Just go with companies that stick with plain accounting speak, that stick with GAAP, that don't manipulate the income statement too much, and look for a history of consistent earnings. If they've got a loss in the last 5 years, you can move on. There's 10,000 issues on the public markets. You don't have to choose from the small number that you read about on CNBC every morning. And then look at the gross margins and look at the net margins. If you can find a company that's earning 15 to 25% net margins, that is a very, very lucrative business. Probably they're going to have gross margin in the 35 to 40% range. Then you can move on to the balance sheet. So the income statement is telling you something about the value of the company's cash flow. If they have consistent revenues and cash flows, say for 5 or 10 years, you've got a company that probably has a defensible moat. Then as you move over to the balance sheet, you can look at, is this going to retain earnings? Because you own the company when you own the stock. So you want to know, is this economic activity being put back into the company in a way that my investment in it is growing? Because when you hand your money over to buy a share in that company, or 10 shares, 1,000, whatever, you're buying a slice of this company because you expect that to be worth more in the future. So have they grown their shareholders' equity? Has retained earnings grown over time? Look at 5 or 10 years. That will give you a really good sense of the quality of the management team. So now you're not just looking at the quantitative issues in the financial, it's really a reflection of the qualitative issues in the management team and their corporate governance. And then finally, the statement of cash flow. Again, like I said before, the one statement that really cannot be manipulated barring fraud. And that will just show you where the cash is going. And if that's a really important statement, because if it's going to like excessive stock option awards, like look at what Elon Musk did recently with Tesla, probably the average investor thinks like, oh, this was horrible. That is, what was it, $55 or $56 billion pay package was, shot down by this Delaware judge. But I mean, what kind of corporate governance is that? I mean, that's coming out of the pocket of the shareholders. So you want to see where that cash is going. If it's going into a lot of equity awards, if it's going to a lot of benefits, you start to get a management team that thinks they own the company. And it's important to remember that when you own the common equity, you own the company, not the management team. They actually work for you. So you want to be able to look at that. And again, you could get the basics in 30 minutes. It really doesn't rise above second grade math, addition, subtraction, multiplication, division. It doesn't even rise to the level of algebra. You really got to learn to read the financial because it tells you the story of the management team. And you want to know who you're getting in bed with, frankly, because that's the people you're trusting to increase the value of your investment.
Well, how important is top line revenue growth to you?
Well, I'll tell you something. My mother had a third grade education. She grew up in post-World War II Greece, and she had a brilliant accounting mind. And she was a brilliant businesswoman. You know what she used to say to me? She used to say, it doesn't matter how much money you make. It matters how much you keep. So, hey, even Enron had great revenues. So did Bernard Madoff, for that matter. It all looked good. Who cares?
Yeah, they also manipulated their earnings, so they probably had good net profits as well.
Well, yeah, but you didn't ask about the net. You asked about the growth.
Exactly. So you don't really look at the top line because that could be manipulated. That could be changed.
Well, you want to see revenue growth, right?
Yeah.
Because a company's like a plant. It either grows or it dies. It's like a human. And companies have a lifespan. They're like humans. They're born. They go through a phase of being a toddler, an adolescent, an adult, and eventually one day they're going to die. Very few companies make it to be 100 years, for example, like IBM or Coca-Cola. So you want to know what phase you're at. But if
Well,
they're in this growth phase,
would
then
you
yeah.
assign a higher premium to something in a very high growth phase, for example?
Well,
Something
yeah,
that
certainly the price to earnings growth. Yeah, absolutely. If there's a company like Nvidia that's growing, you have to keep that calculation in your mind for sure. You can't just say like the P&E could be misleading if it's a high growth company. Nvidia, for example, was an excellent investment, but all along the way, it may have looked expensive in a given moment. But in fact, it was such a remarkable, like once in a generation business that you really need to look at the price to earnings growth.
does it matter to you how much debt they have relative to assets or equity?
Well, absolutely. Yeah. I mean, if there's too much debt, they're insolvent. And they say, the borrower's the slave to the lender. So who really owns that company? It's the
Okay.
lenders. And you got to, sometimes, you get some of these startups and they'll pad their balance sheet tremendously and their bond offerings will be just outright, fraudulent sometimes. So you got to take a hard look at that. And if a company's highly leveraged and their cost of capital is very high, they're going to struggle to focus on their operations. And so as an investor, you're moving from this mindset of just sales and revenue, you're moving to what's the cost of capital and what's the return on capital. And it's the delta in between those two things, which is your return. And if you can compound that at better than average rates of return over even a modest period of time, you should do well.
I know you primarily focus on equities, but do you have a portfolio allocation strategy, a percentage into certain sectors, a percentage into cash, a percentage into alternative assets?
No, not really. I mean, we tried to not run too high on our short book because shorting is just a terrible business, although it really isn't a terrible business right now. But if you're following a formula like that, you're not really looking at great investments. If you look at Berkshire Hathaway, for example, I mean, the vast majority of their returns over several decades came, I think, from 4 or 5 investments. I want to say it was American Express, Coca-Cola, I think Wells Fargo. Look at the Forbes 400. Look at the richest guys in the world. How diverse are their portfolios? Look at Zuckerberg. Look at Buffett. Look at the Waltons. Look at Bezos. Look at Musk. You're talking about like one investment, maybe two. So if you find something great, why would you say, like, let's say you're looking at Nvidia 10 years ago, you're like, this is going to be just amazing. It's going to go up 20,000% in the next decade because these guys are doing something no one else is doing. They're focusing on the graphics processors instead, which is going to be indicative of supercharging these algorithms, and it's going to be this AI flood. You just sort of see the future. Would you stop and be like, well, I shouldn't put more than 5% in because that's my portfolio? I mean, you know what I'm saying? If you know what you're doing and you find something that is truly a great investment, act on it and act on it big.
Do you think that technology has maybe advanced to such an extent that it's become like a utility stock? Like we can't live without electricity, we can't live without water, we can't live without our subscription to Microsoft Office, and so it should be priced differently. The same metrics that we used to use during the dot-com eras, they're no longer applicable. Price to growth is not really a metric you should be looking at. Do metrics change over time is my bigger question, especially for tech.
Yeah, I think they can, David, in a way. And it's funny you mentioned the dot-com bubble because during the dot-com bubble, we didn't have the Magnificent Seven, right? We had the Five Horsemen. Do you remember that? It was like Pets.com and eToys and Lycos. Like, where are those companies today?
I was too young to remember exactly those stocks, but I know what you mean. Yeah.
Well, anyway, so the market is fond of doing that, right? They create a
Yeah.
short list that people can remember. And we live in a society in a time now where people's memories are very short. But these companies have done something really incredible. Microsoft and many of these companies, they've locked people in. They're walled gardens. Even X, which people are so fond of saying, oh, it's this free speech platform. And Elon Musk says, how much free speech absolutely. And the very first, thing that their algorithm considers whether or not you're a paying member. So once you're locked into these platforms, like Microsoft is a great example. And I saw that like at least 10 years ago, their web services were so good and so cheap, but it's a walled garden and it's a toll bridge. Essentially, they can raise their prices. I mean, what are you going to do? You're going to go and you're going to move like 5 terabytes of data off the cloud onto where? You're just not going to do it. But they can raise their prices slowly, and they do it. So they're really, truly great businesses. I mean, from that perspective, whether or not that's ethical, I don't know. That's another discussion. But these companies are going to last for a long time. They're getting bigger and bigger. Obviously comes in multi-trillion-dollar valuations. I think that would have been hard to imagine even 10 years ago. And they're just becoming bigger and more powerful. Same thing with Apple. No one's going to stop using their iPhone. Nobody can change the battery in it if the battery degrades. They've got something going from an economic perspective, which can be repeated, and they've got defensible moats. So these technology companies are not exactly like the dot-com era, the ones which have emerged successfully. I think it's the ones around them that are trying to be in that glow that you have to be careful of.
Anything you don't like? We've talked about your deep value preferences for small retailers. What about things that you would short?
Well, there's some crazy valuations out there. Like Netflix is pretty crazy right now. I'm surprised by it, frankly, because people don't watch that kind of curated content the way they used to. If you look at the rise in podcasts, for example, like we're watching right now, for example, you told me offline, I think it was offline, right? Before we started crying that you don't really watch movies anymore. Neither do I. And yet you look at this valuation at
That's
Netflix,
right.
like, what is going on? And are they running podcasts or something? And then, Tesla, the same thing. You look at this guy, I say, if you went back in time 10 or 20 years ago, well, here's a guy who's really, really unstable. He's, according to the Wall Street Journal, has got a drug problem. He's the head of this company. They got what, a half dozen or a dozen investigations. They're probably going to go away now because he's like a shadow president to Trump. But do you really want to buy a company that the NTSB just said had the highest fatality rates on the road for its cars? That is consistently, according to some short sellers like David Einhorn, who, by the way, is a very smart guy, has basically said this company's involved in fraud. But yet people buy it because it's like a meme stock. We went from like the meme phenomenon. I think a lot of people in Wall Street were watching the GameStop phenomenon say, wow, that's incredible. People will do that. And then it became like the politicized stock with Donald J. Trump stock, where people were betting on it because they supported a political candidate. They weren't reading a balance sheet. They weren't seeing what economic qualities that company had, what margin of safety it might have, or any defensible IP or technology that was innovative or novel, because they didn't have any, frankly. And now we're just creating like this movement of a lot of these accelerationists in Wall Street. They came up with this word hyperstitious, where if you just say something enough, it becomes true. And if you look at the valuation, it's just insane. So yeah, I mean, we have a short position test, not a huge one because it's super risky, but you can't justify those valuations. And just imagine if something happened to Musk, what would happen? Because it's like a cult following. It's not that the company has such incredible, great economic characteristics like Nvidia, for example.
Okay, interesting. On that note, let's talk about the recent appointment of David Sachs to be AI and crypto czar. Let's take a look at my screen here. The CNBC article news came out this week, Father. David will focus on making America the clear global leader in both areas, Trump wrote on social media. He will safeguard free speech online and steer us away from big tech bias and censorship. The general principle of what he's trying to do, I'll let you comment on. But I wonder how his appointment and the direction that Trump wants to take technology overall is going to affect tech valuations and stocks and certain, certain tech types of tech stocks rather do better or worse under this kind of a framework.
Well, they're probably all going to do well, and I think Trump means well. I think AI is potentially, it is so dangerous. So the idea of wanting a tech czar is very important. His interest in protecting free speech, I think Trump means it very much so. I mean, he's lived through hell. He's been, gone through tremendous litigation, and he would certainly say it was unfair and justified. And there have been a lot of regulators who have tried to stifle speech. It's been part of our culture in regulatory bodies. There's no question. So I commend President-elect Trump for doing this and for making this appointment. It's tremendous. I hope it works out. We'll see. I mean, he's got a lot of really great businessmen that he's appointing in his cabinet, and because he is himself a businessman at the end of the day, he's not really a career politician. He's not a bureaucrat. So glory be to God. This is a guy who's enterprising, and we are a capitalist country. Is capitalism perfect? Absolutely not. We're going to make a lot of mistakes along the way. It's a hell of a lot better than the alternatives, though. And
What
you see
change?
this SEC election as well
Yeah,
with
yeah.
Paul Atkins.
What
Tremendous pick. Yeah.
I mean, what changes would you like to see, if any, in regards to government monitoring or intervention or support of the tech sector?
Well, it's these guys have so much responsibility, David. We got to pray for them because it's not an easy job. If you look at Paul Atkins, for example, he's a tremendous pick for the SEC. Here's a guy who is not just a policymaker, not just a lawyer, but a very competent and proven business leader. If you look at what he did with, was it Bennett Funding, I think? Yeah, one of their subsidiaries. The company was a gigantic Ponzi scheme. He took one of the subsidiaries and he grew that to 2,000% to recover value for the shareholders who had lost so much in that fraud. Now, unfortunately, he was also a commissioner from 2002 to 2008, which was the golden era of mortgage securitization fraud. But that innovation, you can almost, it was so esoteric. And it was so obfuscated. It's understandable that the SEC may not have picked up on it right away, what a lot of these big banks were doing. But whenever you look at a country that has real, true financial innovation, David, this economy ultimately benefits from it. Now, it's such a thin line, though, between financial innovation, technological innovation, and fraud. It's always going to attract a certain degree of fraud. But even if 5% of what we innovate in the United States in the area of finance and technology winds up being successful, winds up being meritorious, winds up being beneficial to the country, to the economy, and to the culture, then it will be worth the other 95% that will just be either incompetent or will be outright fraud. So it's a thin line that they're really walking a tightrope between maybe a golden age and a golden age of fraud, which could occur. And we should have some regulation. We don't really want like 1928, 1929 all over again, where people are just openly running syndicates, shorting and distorting and pumping and dumping. We're not even illegal. You don't want that. You actually want sound regulators, but we don't want regulators who are corrupt. We don't want captured regulators, which is what we have right now. We do want greater freedom. We're built for freedom, and so that we can unlock greater human potential. So I'm very optimistic for Trump's picks that he's going to do that. And it's not just the new head of the SEC, it's the head of Treasury, it's the head of Commerce. I mean, these guys are tremendous operators who've been through tremendous experiences, and they're just not your run-of-the-mill bureaucrats or policymakers. So I'm very optimistic in that front. I hope that the cream rises to the top in our society.
Yeah, on that note, let's talk about another pick that Trump recently made. Good segue. Peter Navarro returns to the White House as his trade chief. Now, Peter Navarro, as a trade advisor, what changes do you think could happen to foreign policy and trade with America's partners? We mentioned this offline. Tariffs
Yeah.
are on the agenda. Trump is now threatening more tariffs on China, Canada, Mexico, 100% tariffs in some cases for BRICS countries who Trump said on Truth Social, if they move away from the dollar, we're going to slap on 100% tariff. So tariffs, trade, how will they affect stocks and markets?
Yeah, well, Trump has his work cut out for him. I mean, I think if you went back 10 or 15 or 20 years ago, the US had a prestige and the dollar had a prestige that we unfortunately have lost to a certain degree. Keep in mind, Trump wasn't raised in DC. He was really raised in a studio set on The Apprentice. So he understands, I think, drama pretty well and maybe even using it effectively. I do believe he's a deal maker, though. I think business for him growing up as a commercial real estate developer in New York, when I don't grab on a child. I mean, well, he actually did as a child. His father was in business as well. He understood it was about making deals. His book was The Art of the Deal. So I think he sees himself as a deal maker, but he also sees himself as sort of dialing up what he wants in an almost dramatic way to send a message. I don't know how serious the BRICS are taking them, though. I mean, the world isn't what it used to be. China's basically the largest economy in the world, and Russia's in a different position than it used to be. But I do believe he'll do what's in the best interest of the country. He will try very hard, and hopefully Congress will get behind him on everything he tries to enact. And I think that if it came to that, where you had those sort of tariffs, those would be very deleterious effects on the economy, on the consumers, and so forth. And I don't think he's going to crash the economy. I don't see him doing that for a second. So there's probably some bluster in there. He's probably trying to send a message. It's probably dialed up more than reality, and trying to get these guys to the table to do something productive.
You don't think he's going to crash the economy? Let's focus in on that. So the worry from some economists, not all, but from some economists, is that he could potentially take these tariffs too far. Remember that in 1929, 1930, the Smoot-Hawley tariffs were enacted. The Smoot-Hawley Act, according to some economists, was the trigger for the Great Depression. Closed off trade. 20,000 items were used or targeted for tariffs, and things were unaffordable. Protectionist measures stimulated were just stopped growth, and the Great Depression happened. Could we get a second Great Depression? What's different this time?
Well, you could always have a depression, but I would argue that we don't really know the exact cause of the Great Depression. What we know is it just one thing led to another. I mean, you could look at the extraordinary speculation taking place in markets at the time, for example, like we mentioned earlier, the open syndicates and the open pump and dumping that were taking place on market. I mean, you were seeing people it was the epitome of speculation, par excellence. So that was certainly part of it. But, these protectionist measures, yeah, that must have played a role for sure. And I just don't see Trump doing that. I mean, it wouldn't even behoove his own business interests. Again, I think if that were to happen, you would probably see it from a career politician or a bureaucrat who's been a policymaker their whole life and never actually run a business. I mean, this is a guy who's run a business. I mean, he's actually built companies. So I just don't see him doing that. It wouldn't even behoove him to do it. The Trump organization is still a large organization. It would hurt him very much. He's surrounding himself with free market capitalist guys, even fund managers. For example, his Treasury pick, a little bit odd, but a former fund manager at Soros Fund Management. These are guys who've built businesses. If you look at his commerce secretary, same thing, former leader at Cantor Fitzgerald, a rock solid guy. It'd just be really hard for me to believe that he'd follow through on those policies and crash the economy. I mean, Trump has always had his detractors. They've always made these outlandish prognostications about what he's going to do, but he never actually does them. Keep in mind, we've seen 4 years of Trump in office. And, though his behavior can be a little unpredictable sometimes and maybe a little dramatic, what he actually delivers is far less dramatic and far more beneficial to the country, in my opinion.
Well, that's a good segue to our final segment. I'd like to ask you how you integrate or keep separate your faith and your work. Do you take your faith and apply that to investment principles, or are there certain sectors you would not invest in because of your faith?
Yeah, well, if we want to try to be, sincere about our faith, we live our life, or Christians in particular, we live a life in Christ. If it comes down to just using the right words and virtue signaling, then, we're hypocrites. Obviously, I'd rather not own companies that make ammunition or, own casino chains or something like that. Yeah, I've never done that. I don't want to do it. Um, whether or not Christians should even be serious Christians should even be involved in markets as a whole of the discussion. At the end of the day, my conclusion, we probably shouldn't be, but the problem is we all already are. So all I've ever tried to say in my work is, look, if we're all going to be involved in capital markets, either directly or indirectly, I mean, most people have a 401k or an IRA or investment manager. Even if they say, what is this guy doing? He's a priest and he's a hedge fund manager. They say, how does that happen? I say, well, even the most serious members of your parish are involved in capital market. All I'm saying is let's try to be a little bit intelligent about it, because if we're not intelligent about it, that does not make us better stewards of capital. And there certainly is a concept of good stewardship in the gospel. So we should be intelligent. We should be good stewards. It's easy to make money off sin. Let's be honest. You can always compromise. If you want to buy OnlyFans or something that becomes a publicly traded company, I mean, nothing could be easier. It's hard? Finding value by reading financial statements. That takes a lot of work, and you don't have to compromise yourself. So there's always a way to make more money by cutting corners. But the hard thing to do and the right thing to do are almost always the same thing. And you know what? If I have to get bad returns or no returns or negative returns, but do the right thing, I'll just take that any day of the week, because it's just not that important at the end of the day, what we do. Honestly, police officers add more value to society.
Absolutely. And final question, what are some common mistakes you see other investors make that maybe you would try to avoid yourself or advise them not to do?
Well, just really briefly, I would say that you can broadly categorize the market into two groups. There's speculators and there's investors. Speculators believe they can see the future. Investors think they cannot see the future. For the speculator, he says, well, if I can buy a dollar bill for $1.10, that's okay, because tomorrow's going to be worth $1.20. Think of the housing bubble. Think of any bubble for that matter. Think of the tech bubble, the AI bubble. The investor doesn't think that way. He says, could I find a dollar bill for 50 cents? Because if I do, if I'm wrong, I'm covered. Maybe it's not worth $1. Maybe it's worth 90 cents. Maybe it's worth 80 cents, but I only paid 50 cents. So I'll still be okay when I go to sell. If you buy right, you don't have to worry about selling. But as it turns out, being a value oriented investor is not really something you can learn. You can't say I went to Harvard Business School and I'm a great value investor. I've learned it's really something you're born with as a personality type. And it's exceedingly rare in markets. Most people I've learned are just speculators. You're just wired that way. It's fun for them. I always tell people, if you're going to speculate, you might as well go to Las Vegas, you have a nice meal, see a nice show, then you lose your money. Wall Street's way more efficient than that. You don't even get those things. And so, I would just say that to people, keep that in mind. Know yourself and know how you really feel about what you're doing. And if you're just watching price movements, blinking red and green numbers on the screen, or you're jumping in because everyone else is jumping in, it doesn't usually end well. You can be successful for a short period of time, maybe a month or a quarter or a year, or somebody's a speculator, but ultimately you're going to lose your money. There's no speculators on the Forbes 400. I'll tell you that right now.
Okay.
So,
Where can we learn more from you and your investment philosophy? Obviously, you have a very good track record. You have a very good very good career as both a priest and a fund manager. So, where can we learn from you?
We have a couple different sites. We have lemelsoncapital.com, which is just my last name, lemelsoncapital.com. There's some more information on our history on the About Us page. There's amvona.com, which is our blog. It's Alpha, Mary, Victor, Oscar, Nancy, Adam.com. But I think the best place to listen to any commentary would probably just be our podcast. It's a nascent podcast. We just started maybe 8 or 9 months ago, but we've had millions of impressions across different social media. And it's I think probably one of the best places to hear the way we see the world.
All right, we'll put the links down below. Father Emmanuel, thank you very much for joining the show. I appreciate it, and thank you for educating us. We'll speak again soon.
Yeah, absolutely, David. Thank you for the invite. It's such a pleasure to join you. I enjoy your show so much. Take care.
Thank you very much, and thank you for watching. Don't forget to like and subscribe.